But we begin with the markets, as we usually do here, with the S&P 500 coming off a record close. Jay Woods, Chief Market Strategist at Freedom Capital Markets, joins me now. Jay, welcome to the show.
Hey, it's good to be back.
So a few moments ago, I announced that ICE has made a strategic investment in Polymarket, $2 billion. What are your thoughts on this?
My thoughts are this is a great partnership. I mean, a $2 billion investment will go a long way. Polymarket is revolutionizing how the younger generation is looking at markets, not stocks in particularly just yet, but there could be an avenue for them to actually, bet on stocks. They already bet on or, speculate on what earnings are going to do. Are they going to beat? Are they not going to beat? Elections. Polymarket has really gotten the pulse of who's going to win an election, who's going to lose an election. So it's great for consumer sentiment. It's great for speculating. And to me, when they merge with or join up with someone with like ICE with our data services, this is a perfect symmetry. I can't wait to see what Mr. Sprecher does, because his investments, knowing the stock and being here for so many years, have always done well. And when he invests in something, there's a good reason for it. So he sees a lot of growth here, and I'm excited that they just came and made that big announcement here at the stock exchange.
Meanwhile, the markets are continuing to rally despite the government shutdown. I just said that the S&P had its 32nd record close of the year yesterday. What do you think is driving these gains?
It's crazy. 7 days of the shutdown, 7 straight days of rallies in the S&P 500, 32nd new high. We had talked about the possibility of the shutdown being a non-event here for the market. So far, so good. The shutdown is not going to affect earnings growth. It's not going to affect M&A activity. And we saw some big news yesterday on the AI investment front with OpenAI and AMD. We had a merger in the regional banks with Comerica and Fifth Third. That's what's driving this market. The shutdown, if it goes on a couple weeks, then the story will change, because that will have an impact on GDP, and that will not be good going forward for the economy. But right now, it seems like we're navigating this well. We expect maybe Polymarket, actually Polymarket says 70% chance this goes on behind, after October 15th. So it looks like resolution will be sometime later next week or the following week. We've lived through this before. The market's not shrugging it off. We're focused on earnings. Next week, we kick off earnings season with JP Morgan on Tuesday. Have a couple key ones this week in Delta and Pepsi. So it's a lot of noise. It's scary headlines. But right now, we're more concerned that we're not getting data from the government because of the shutdown. We won't get those jobless claims on Thursday. We didn't get unemployment on Friday. And for a Fed that wants to possibly cut on October 29th, we need these data points for them to justify and rationalize, yes, this is the path we want to go. So we'll listen to Fed speakers during the week, and we'll worry about the shutdown. I think that will be more of a concern next week.
Do you think this differs from previous government shutdowns?
Yeah, it does and it doesn't. It doesn't in the sense that the market is not using this as a panic selling point. The market is digesting it as, a negotiating tactic, business as usual. When the sad fact is, people are not getting paid. People are not, may not come back to a job. But as far as the market goes, and that's what I study, the market is taking this in stride. Past shutdowns have not had the implications. The biggest shutdown was, ironically, under President Trump in December of 2018. It was very volatile going in, but it was a different time with Fed policy. And then we rallied 10% coming into the shutdown as we were shut down. It's a tough comparison given where we were economically and with the Fed. But yes, we've lived through these before, and the market has really shrugged them off historically. So I don't expect anything different this time.
And AI has really been moving the markets. You mentioned that deal between OpenAI and AMD. What do you make of that? Can you share more?
Yeah, I mean, one, it's interesting because they did it with AMD and not NVIDIA. So we're seeing a lot of competition in the space. NVIDIA was actually down yesterday, minor, 1%, but we're seeing competition, but we're seeing continued spend. And we're seeing rotation within the semiconductors. We're seeing rotation within the technology sector. But this AI spend is a great story now. How it resolves itself years from now, I don't know, because there is a rotational spend where we're helping this company who's going to help us, and then, where does the bottom line come from? But right now, we're seeing continued growth, continue momentum in this space, as it's still early innings in this AI story. So to me, when you get a headline like that, yeah, you're going to get a pop in AMD, and it's worthwhile because this is going to help their long-term growth story. So they overreact initially. We'll see what it means for the long term, but for those people that have been in the stock and are just investing now, I think the next 6 to 12 months, this is going to be a good tailwind for them.
Some of our guests who come on say that we're in an AI bubble.
Yeah.
What is your take on that?
Well, history may judge this as a bubble. I mean, bubbles take a long time to inflate. Some bubbles can be bigger than others. And there are pockets that are a little bubble-licious, if you will, with these quantum stocks, the run they're on. The stocks are straight up in the air. It's a little euphoric. But overall, when you say bubble, we're not seeing PE ratios in these magnificent stocks, in the large cap stocks, that are egregious. When we were living through .com bubble, we saw PE ratios of Microsoft 50, Cisco 80. Nvidia has a low 30s multiple. Meta, Amazon, nothing crazy. Tesla is the outlier when it comes to multiples, but that's more of a cult stock. So to me, I don't see valuations that are excessive, that don't really strike logic. We're seeing it in the quantum stocks now. The IPO market's the other tell for me. We are getting a hotter IPO market, but there's still more companies private that have not tapped the public markets. When you start seeing people rush, like we saw in the SPAC boom in 2021, what did we do? We peaked. That was a little euphoric. There's no euphoria, there's excitement, but I wouldn't call this euphoric. So if you're in a bubble, it's a great place to be. Enjoy it. There's a lot of money to be made. So to me, as it inflates, we'll talk about warning signs of what could cause it to end. But when you're looking for the bus that's going to hit you, you never get hit by that bus. It's something else that you don't expect. So for me, let's enjoy this bubble. I think it can inflate for quite some time, and history will judge it later on.
All right, and earnings season is right around the corner. Delta will be reporting on Thursday. We have about 30 seconds left. What are you going to be looking for?
Two, Delta and Pepsi. Delta, they've gone up the last 3 times and then faded. Let's see if the guidance is good, if they can break out to new highs. Transports have been lagging. We'd like to see the transports participate in this broader rally. Pepsi, Staples, another laggard. It's been underperforming Coke. Let's see if they can beat and get back on the winning track. So those two will set us up for next week when the financials report, and then the fun really begins.
All right, Jay Woods, Chief Market Strategist at Freedom Capital Markets. Thank you so much for joining us.
Thank you.
Coming up, a new survey review.